business ventures and charitable ventures for years, have been great friends to us in Louisiana through all of our disaster that we have experienced, and so we've gotten to know them very well. I'm looking forward to their presentation. They'll take you through all the different pieces of the CARES Act, and then Edmund Gearing of the Baton Rouge Area Foundation will go ahead and take you on facilitate some questions and answers, and then we will close up. So with that, I'm going to turn it over to Jim to get started. Can you unmute yourself, Jim? Jim's frozen.
Okay, there we go. It came. All right, sorry about that. It's always the most frightening part is technology. Okay, let's. All right. Okay, sorry about that. Now I think we've got it under control. And my video is gone too. Well, yeah, having trouble with that. So anyway, we're gonna provide an overview today. We're gonna provide an overview today to the stimulus package for small businesses and nonprofits. This was included as part of the CARES Act that was passed by Congress last month. The guidance continues to come out from both the Treasury and the Small Business Administration. So one of the things that we should emphasize is that this is current as of today. Some guidance came out last night and earlier this week, so it's rolling out slowly. So you have to continue to watch what's happening as part of this. Today we're going to go over the Paycheck Protection Program, which is the main loan program that people are hearing about. We'll also talk about some other loan programs, tax credits that are available, as well as charitable deductions and some employment tax deferrals. We also think that there's probably a pretty high degree of likelihood that there will be a stimulus package 4. So this was the third one, was the CARES Act, and we think that there probably will be a 4th one, despite a little bit of back and forth that's going on in Congress right now between Mitch McConnell and Nancy Pelosi and on some of these issues. I think everyone agrees that more money is going to be needed to get us out of this. And the expectation is that part of the next stimulus package will include additional funding going in to some of these programs, in particular the Paycheck Protection Program. So the Paycheck Protection Program, I'm going to head into that now. It's a loan program to help small businesses and charities and veterans organizations to continue to pay workers and not lay them off, hence the name, Paycheck Protection. And then it also is designed to help you pay some other bills like rent and mortgage. The thing that makes this so attractive is that the loans can be forgiven so that they, in effect, become grants and do not need to be repaid. And we'll go through that in a minute. Congress appropriated almost $350 billion for this program. The SBA announced this morning that as of April 13th, 250 million or $250 billion, sorry, 250 billion has been allocated, and sort of basically they've committed or approved PPP loans equally $250 billion. So there's 100 billion left. And these loans are being provided on a first come, first served basis. So if you're thinking of applying, it's something that you should do very soon. The application, it is treated as being received when it's completed. So when the bank completes its review and submits it to the SBA, that's when it gets in the queue. So you really do want to do this fairly quickly. Who's eligible for loans under the PPP? As I mentioned, it's for small businesses, and in the nonprofit area, it's 501c3s is the primary one. So 501c4s, advocacy organization, trade associations, 501c6s, social clubs, 501c7s, those are not eligible to receive a PPP loan. My colleague Bridget will talk in a few minutes about another loan program where other nonprofits can seek to participate. These are also targeted for small groups. So even nonprofits, they are supposed to be 500 employees or less. And employees include part-time and seasonal employees, but not independent contractors. And not volunteers. So if you have 200 full-time employees and 400 part-time employees at some point during the year, you would be treated as having 600 total employees and not qualify. There is another way to qualify under SBA industry codes, but for most nonprofits, going in under the 500 or less employees is going to be the way to do it. Other small business concerns that are eligible for 7A, SBA 7A loans, which is what this PPP is, are also eligible. The only one I'll mention there that may be relevant is it's a little complicated, but it looks like nonprofit cooperatives, agricultural cooperatives, electrical cooperatives. It looks like they are eligible to receive PPP loans, and that's under this second bullet of eligible for 7A loans. And then, sole proprietors, independent contractors, and the self-employed are also eligible to receive them. When you are applying for a PPP, you're going to have to certify to the accuracy of the application, of the information that you're providing to the bank. And if you knowingly misrepresent something in this, that would be fraud. And so you do want to look very carefully at sort of the application and what you are sort of putting in there and what you have to certify. Some banks have added additional certifications other than the ones that the SBA requires. There's certainly a lot of gray areas still under the PPP. The legislation was put together very quickly. It's been rolled out incredibly fast. The rollout's been a bit bumpy, but given the speed and the size, I'm amazed that it's going as well as it is. So if you are doing something or, like treating certain employees in a way or doing your calculations in a certain way where it might be unclear under the rules, but you think it's right, disclosing that on the application just so it's clear, so that if the bank disagrees with you or the SBA disagrees with you, you have laid that out very, very clearly. And I'll give you an example of some of those things. Now, what's the amount of the loan? Under the PPP legislation, the maximum amount of a loan is $10 million for any applicant. for most, that's not going to be sort of the amount that you're able to get. Because the program is designed to help you keep people employed, they base the loan amount that you can receive on your average monthly payroll costs. And we'll get into the definition of payroll costs in a minute. But you have two ways of calculating your average payroll costs if you are, if you've been up and running for a while. And that is the previous 12 months from the time you apply. So if you're applying now in April of 2020, it would be April 1st, 2019 through March, 30 days, March 31st of 2020. So that would be your 12 months. Or you can look at the calendar year of 2019. And what you do is you look at what your payroll costs over that 12-month period, you divide it by 12, and that gives you your average monthly payroll costs. And then you multiply that by 2.5, and that equals your maximum loan amount. There are other periods if you have a seasonal, if you're a nonprofit who runs a summer camp, obviously you're going to have different employee counts during that. So you have a different period that you look at for there. If you haven't been in business for a full 12 months, then there's a separate period sort of laid out. Now, what's the definition of payroll costs? And this is certainly one of the things that has caused the most, it's lots of confusion, but over the last month or so since this came into being, the Treasury and SBA have clarified things a bit. So what is included? Gross compensation, so salary, wages, commissions, tips. And this is the total compensation that you are paying to your employees. You don't subtract anything out for taxes or anything else. So, what I would think of is you are looking at box 1 of your W-2. Unless you are paying an employee's FICA, you would look at box 1 of the W-2. Because that should include everything that you've paid them, if you're using the 2019 period. You also include payments that you have made for vacation, family leave, sick pay. Sort of the most important, other than the wages, I think, are the contributions to group health and the payment of retirement benefits, since those are expenses that most employers will have. Those get added into total payroll costs. What's not included? The first thing is they only let you include the compensation up to $100,000. So if you have someone who makes $120,000 a year, you would be able to count $100,000 in their wages for the 12-month period, divide that by 12, and for those who can do better math than I can, that would be sort of the amounts, like 8,300 or something, I think. And that gets added in to your payroll cost that then gets multiplied by 2.5. You don't include payments made to independent contractors and sole proprietors. So you also don't include the employer's portion of FICA. So, that 6.2% and then the Medicare amount that you pay, that does not get included. The employee portion of FICA does get included because we're doing gross compensation, so don't take any amounts out. Another thing that's important that I should have mentioned with the 100,000 cap, I apologize. The 100,000 cap is only on the cash wages that you're paying. So if you are paying retirement benefits, for example, that equal X% of an employee's salary, and that's your contribution to their retirement plan, and you base that on the person's $120,000 salary, so you're paying 5% into their retirement plan, so that would be $6,000. You get to include that full $6,000 in payroll costs. You don't have to only multiply it by the 100,000 cap. And that was something that was unclear at first, but it is clear. The other thing that may apply to some is compensation paid to employees whose principal residence is outside of the US. So if you're running an international program and some of your employees are outside of the US, you don't get to include their payroll costs in the definition. How do you use your PPP loan proceeds? So you are supposed to use them to cover payroll costs, which would include the retirement benefits and state and local taxes. You can use it for rent, utilities, and if you have a mortgage, you can also use it for your mortgage, the interest payments on your mortgage, not the principal amount. There is guidance out there that seems to indicate that you have to use the loan proceeds, 75% of the loan proceeds, for payroll costs. We've seen some guidance, and we see some people are taking the position that this 75% requirement is only applicable if you are dealing with the loan forgiveness, which I'll go through in a minute. But our view is that the better reading is that you have the PPP loan period is a 2-year period. The term is 2 years. So if the amount doesn't get forgiven, you have to pay it back within 2 years. Our view is that you have to use the proceeds over that 2 years for 75% of which need to be payroll costs. Obviously, most of you are going to try and get the loan forgiven, so this won't be won't be an issue. And I will let me go into the loan. Here's the term. So the term of the PPP loan it's a 2-year term, as I just said, and the interest rate is 1%. The statute had different length. It said 10 years and 4%. But under the regulations, this is what the SBA, the Small Business Administration, has said. And lenders are required to defer payments on covered loans for 6 months. So you do not need, if you get your loan, you do not need to start making payments for 6 months. You should know that interest will continue to accrue during that deferment period, but you don't have to pay it. So give us some time for the economy to get reopened and hopefully money to start flowing. So here's the other big part, the math. Other math part of our test is loan forgiveness. So this is what makes the PPP so attractive. I mean, a 2-year loan at 1% interest is nice, but getting money from the government that is a grant that you never have to pay back is really nice. So this is what everyone's hope is. And it is you get the loan forgiven, the principal and the interest. So you'd never have to pay anything back. And here's how it works. When you apply for your loan, it gets processed, you get your loan distribution. And let's say you get your money today on April 15th. You then have 8 weeks. So April, May, June. So June 15th is the 8-week period over which you calculate your loan forgiveness. And the same things that go into the amount of loan that you can get go into the loan forgiveness. So payroll costs, interest on mortgage, rent payments, and utility amounts. Those go into the loan forgiveness. And for this, it's clear that 75% of the amount has to be spent for payroll costs. So if you get $100, that means you have to spend 75 on those things that are payroll costs, wages, retirement benefits, health insurance, and then 25% can be used for something like rent. If you ended up, getting $100 and you spent $50 on payroll costs and $50 on rent, you would only be able to get, as part of that, I'm going to have trouble doing my own math, but a little less than $75 would be your loan forgiveness. You'd have to take figure out what that $50 you paid in payroll costs is, what that is 75% of. And so that's important. Where this becomes a bit of an issue is for those of you who are shut down, and let's say you're not able to reopen before the 8-week period. It's going to be difficult for some people to be able to rehire if they've laid people off, or to keep paying people if they don't open up within this period. But for now, this is the amount, this is the time period that you have to use, and this is the calculation. The borrower is then supposed to let you know about how much, whether you are getting your loan forgiveness or not, within 60 days after you submit the application. And for the application, you are going to have to submit supporting documentation. So you'll have to submit, if you use a payroll provider, a PEO, you would need to supply a report from them about your payroll, or you'd need to provide materials about the payroll to make sure that it is, that you can support that. And let's see. I think that's probably what we need to sort of deal with for that. There is a reduction in the loan forgiveness if you don't hire people back, because the intent of this, or you don't keep people on if you haven't laid them off. The idea is this is supposed to help you maintain your payroll, not lay people off or rehire people if you had to lay them off. And so there are two reductions that you have to look at. One is the employee headcount, and that's based on, if you look at that 8-week period, you divide the 8-week period into two monthly periods, so 2 4-week periods, and you average that together, and then you compare that to the number of employees that you had sort of during that prior period that you used, the past 12 months or 2019. And then for the total employee compensation, you look at the whole 8-week period. You don't divide it into months. You don't do sort of any averaging. So you look at the 8-week period, and then you compare it to the amount of wages that you paid, or compensation that you paid in the prior quarter. So it would be, for us right now, it would be the January to the end of March of 2020 would be your prior quarter. And to have no reduction, you have to be paying during this 8-week period 25%, you have to pay 75% of the compensation that you paid in the prior quarter. So it can't be reduced by more than 25%. If you laid people off, they let you rehire people. And if you rehire them before June 30th, then it will be as if you've never laid them off. And so they wouldn't be included in, you can include them in your employee headcount. They wouldn't be included as a reduction. And it's important to know that if you're rehiring people, you don't have to rehire the same people. You just have to rehire the same headcount for it. we've got this June 30th date. We also have this 8-week period. So in my example, I get my loan today. June 15th is the end of my 8-week period. Excuse me. I would need to rehire people within that 8-week period. So certainly before June 15th, and I'd have to start paying them wages so that their wages would count as part of the loan forgiveness. And so that's important to keep in mind, that this forgiveness for, this rehire exception is really the earlier of the 8-week period or June 30th. And with that, that is the end of the PPP stuff. And now I'm going to try to give this to Bridget. Okay. I think you've got it, Bridget.
Okay. So if you all can just bear with me while I...
Bridget, while you're getting set up, I wanted to remind the participants that there's the option for Q&A at the end. And if you have questions, please type in your questions, which we'll be reviewing and asking at the end of the session.
Let's see. My apologies as let's see. Jim, can I give you back the slides? I'm having trouble with it and you can...
Yep, and I'll move them for you. Yes,
okay.
Technology that gets us. It's always the tech.
Okay, great.
Okay. All right. There you go. Yep, got them. So
I cannot see them though.
I'm on slide 13.
Okay, great. All right, so apologies about that and thanks for bearing with us on this. So today I'm going to be covering several of the other benefits that are available to nonprofits under the CARES Act. And the first one of those is the Economic Injury Disaster Loans, or EIDL program. Now, this is a pre-existing loan program that was already available to nonprofits under existing law, so it may be one that you're already familiar with as opposed to the 7A loans, which previously had not been available to nonprofit organizations. Now, under the Economic Injury Disaster Loan programs, nonprofits are eligible for loans of up to $2 million at a fixed interest rate of 2.75% for nonprofits or 3.75% for other businesses. Now, I would say that one particular wrinkle that we're seeing here for nonprofit organizations, or really for any applicants under the EIDL program, is that although the statute authorizes loan amounts up to $2 million, what we're hearing from press reports and anecdotally is that the SBA is actually limiting the amount of loans that are eligible to be dispersed. That includes the $10,000 emergency advance that I'll be talking about in just a moment. But in addition to the emergency advance, they are capping loans at this point at $15,000 or 2 months of working capital. So that is not something that I think that we've heard in any sort of official statement, but that seems to be the response that many applicants are getting as they go through the EIDL loan process.
Bridget, sorry to interrupt, but I think people, they also are not able to see the screen. So I wonder if Jared can help, because I seem to have the control of the screen, but people can't see it.
People can't see it.
I think I've done everything on my end that I need to.
Okay, let me see.
And I still have control of it.
Let me try one more time to see if I can do that. I apologize for
Jim? Can you hear me?
No, we're having a little trouble. People aren't able to see the screen.
Okay, can you try to share your screen again?
I don't have anything that says share screen. I mean, that's, here, let's see. There we go. There we go.
So this is my screen. Is it? Can you see that now?
Yep, I think you're back.
Okay.
That is agenda for today.
Yeah, I will get back up to where we are.
Wonderful.
Okay.
Sorry about that.
So thank you everyone for your patience as we adjust to this new technology. I think many of us are used to having AV folks that can hold our hands as we go through these presentations. So thanks so much for everyone being so patient.
No problem.
Going back to the EIDL loans, so in terms of eligibility, I was talking a little bit before we were trying to fix these snafus about the maximum amount. So at this point, again, anecdotally, what we're seeing is that they're capping amounts above the emergency advance at $15,000. So still to be determined about how that's going to shake out in the long term, if that's just a temporary measure to try to make sure that the funds are dispersed among a wider range of organizations. In terms of eligibility, Jim mentioned with respect to the PPP that a narrower set of tax-exempt organizations were eligible for PPP loans. That is in contrast to the EIDL loans. The EIDL loans are available to a much broader range of nonprofit organizations. So not just C3s or C19s, but also trade associations, advocacy groups, social clubs, so a wide variety of nonprofits. Although there are a few eligibility requirements you still do need to keep in mind with respect to EIDL loans. The first being that if your primary purpose is to engage in lobbying or political activities, then you're also ineligible for an EIDL loan. And then also something that I did not know until just a few days ago, but if you have substantial gambling revenues, so if your revenues are over 1/3 gambling, if you run a bingo hall, that was the question that I got recently. If you run a bingo hall and more than 1/3 of your revenue is from bingo, or if your primary purpose is to engage in gambling, then you are also ineligible. So that could hit some nonprofits that have substantial bingo or other types of gambling revenue. In terms of eligibility as well, the nonprofit has to have experienced economic injury as a result of a disaster. Now, fortunately or unfortunately, we've had a national disaster declaration in place across the country as of the start of the COVID crisis. So to the extent you have decreased revenue, interruptions in your supply chain, you've had to shut down, et cetera, then you would have been deemed to have experienced sufficient economic injury so that you can be eligible for an EIDL loan. In terms of use of how you can use idle loan proceeds, they are somewhat broader than PPP proceeds. Similarly, you can use them for payroll or certain rent or mortgage payments. But then in addition, you can also use them for accounts payable or for certain increases as a result of your supply chain interruption. So again, you know, a slightly broader range of types of costs. Now, going to the emergency grants which I referenced previously, because you know everything is taking so long, and because even in best of cases it can take a month or more to receive idle loan proceeds after you apply to the SBA, there's a special emergency grant that is available. It is you know, under law, it has to be dispersed within 3 days. That's the mandated period of up to $10,000. Anecdotally, it's not clear to me that I'm always seeing that 3-day period being met, but that is what it's supposed to. That is supposed to be the processing time period. The applicant for an emergency idle grant has to be generally eligible for idles, has to have been in operations since at least since January 31st, 2020, and they can use the idle grants for any of those types of purposes that we previously described. So payroll or other costs, rent, increased supply chain costs, etc. Now, the nice thing about the idle emergency grant is that $10,000 amount does not need to be repaid, even if the applicant is rejected for an idle. So that is the one part of an idle grant that has a more PPP-like feature. To contrast the terms of an idle, though, in general, with that of the PPP, the terms are not as favorable. Unlike PPP loans, in general, other than this $10,000 amount that we just discussed, there is no loan forgiveness for an idle loan, and but there is a deferment period. So between the loan origination date and when you have to start paying, there is a 1 year period. Although interest does accrue during that 1 year period. One other issue to consider, and we'll talk about this a little bit more as we compare and contrast the various programs, to the extent that you are also applying or end up receiving a PPP loan, then that amount is subtracted from your loan forgiveness under the PPP. So essentially, the amounts are you don't get to get both. You don't get to get both amounts, and your idle loans are essentially refinanced into your PPP loan. One wrinkle that I saw recently as part of the application process that you should be aware of is that banks are seeing some applicants include potential idle amounts on their loan applications, and that's something to be careful about, particularly because of the reason that I mentioned, that even if, say, you've already applied for an idle loan of $2 million, the hypothetical maximum, right now we're not seeing any applicants receive, or it appears the applicants are not receiving the maximum amount that they otherwise might be eligible for. So if you are, you don't want to assume that you've actually received those amounts. So you want to have discussions with your bank about what you should be including or disclosing with respect to idles as part of this process. Now, moving on to the enhanced charitable deductions, enhanced charitable giving incentives. As part of the CARES Act, Congress did try to incentivize both individuals and corporations to increase their charitable giving. You know, that may be a stretch for many folks and for many companies during this period. But there are a number of ways that the rules on charitable giving have been altered through the end of 2020. First of all, for individuals who do not itemize their deductions, there is a one-time above the line deduction for cash contributions of up to $300 made to charitable or religious organizations that are considered to be public charities. This incentive does not apply to donor advised funds or DAFs or private non-operating foundations or supporting organizations. Similarly, individuals who do itemize their deduction have a nice incentive here to the extent it's applicable to them, in that the current limits for charitable contributions in cash, so 60% of adjusted gross income or AGI, those deductions are suspended for the rest of 2020. That makes cash contributions fully 100% deductible during this period, and those amounts can also be carried forward to future years. So for taxpayers who are in this fortunate situation, there could be a considerable advantage for them. As with the deduction for non-itemizers, this enhanced deduction only is applicable to public charities and not to DAFs, private non-operating foundations, or supporting organizations. And for corporations as well, unclear to me as to how many corporations will find themselves in this position, but the current limits on deductibility of charitable contributions from corporations have been increased from 10 to 25%. And then for food donations, the deduction has also been increased to 25%. So, you know, this is something, you know, as this benefit is available through the end of 2020, and this is something that I have heard at least some nonprofits consider, you know, discussing with certain groups of their donors, and I've seen it with some major gifts actually as well, where instead of contributing through or to a private foundation, the client has decided to, the individual high net worth client has decided to contribute directly to the charitable recipient. Now, a few benefits that apply to nonprofits as opposed to just their donors. There are a number of different employment tax incentives. So there is an employee retention credit for employers. It's a refundable tax credit for 50% in qualifying wages up to a $10,000 cap paid to each employee by an eligible employer. So this means that if you pay $10,000 in qualified wages, there is a credit of $5,000. Now, what the wages are, what wages are includable here depends on the number of employees that you have. To the extent you have over 100 full-time employees, then the covered amounts only are only paid to employees not providing services. With respect to 100 or fewer employees, it applies to any wages. Now, in addition, there is also a payroll tax deferral, which allows for deferral of payment of the employer's share of Social Security tax for the period between March 27th, 2020, that's when the CARES Act was passed, through to December 31st, 2020. Initially, and what you'll see here on this slide, initially the understanding that we had was that this was only going to be applicable to employers that were not taking advantage of PPP loans. However, it's now become clear that this deferment is actually available until the PPP loan is forgiven. So the normal rules would apply with half of the deferral available until half of the amount deferred paid by 12/31/2020, 12/31/2021, and then the other half paid by 12/31/2022. But I would say that employee retention credit for employers, that is not available to PPP recipients. A few other benefits that you're probably aware of. There are payments to individuals who have income up to $75,000, and then those amounts are phased out for individuals that are reporting more than $99,000 in income, or joint filers reporting more than $198,000 in income. And to the extent that the 2019 tax return has not been filed, which is the case for many, then you would use the 2018 return for these purposes. There are a variety of different restrictions on who can receive CARES Act benefits depending on the individual's immigration status. And we're also seeing certifications requiring, various about immigration status on the PPP loan application as well. And then in general, there's additional access to retirement plan funds. So I'm not going to go into any of these benefits in any details because it's more applicable to the individual. So I think that is, Jim, do you want to take over the slide?
Okay, hopefully that worked. And my button is off. Whoops. There we go.
It looks good.
Okay, so what we wanted to do for this is just go over and do a comparison of the different kinds of relief. So as we mentioned, the PPP is available. You end up, the forgivable loan, it's a forgivable loan. It's at a 1% interest rate with the 2-year maturity. The EIDL is a loan that's at a 2.75% interest rate, and it has a 10-year period. The employee retention credit, which if you get the PPP, then you can't get this. You get a credit of 50% against it's a refundable tax credit, so it's probably not going to be too beneficial for most nonprofits. And the payroll tax deduction. And just to go over one more time, the thing about the deferral of payroll taxes. So if you applied for a PPP and you got it, and then you find out in, July, for example, that your PPP is being forgiven, you would be able to defer your FICA, employer FICA taxes from March 27th, 2020 through, in my example, to July 1st, 2020. And those FICA taxes, employer portion of FICA that you would have had to have paid, will not have to be paid until 12/31/2021, 50%, and 12/20, and then 50% at the end of 2022. So that's the sort of the benefit of that. My dog has decided to come in here and start barking, so that's okay. Sorry about that. The maximum amount of the loan under the PPP, we went through and described, how you calculate that. And on the EIDL loan, the maximum in the statute is $2 million, but the SBA is limiting these amounts to $15,000 is what we are hearing. Eligibility on the PPP, for nonprofits, the key issue is it's pretty much C3 only. EIDL is available to all kinds of nonprofits. you still have to satisfy under the PPP the size limitations. And for the idle, there is no cap on the size of the organization. The loan benefits, you know, as we went through with the PPP, it's 2.5% times your average monthly payroll. For the idle loan, it looks like it's $15,000. You also get this $10,000 emergency grant under the idle, and that $10,000, just like the $15,000 if you get an idle loan, both of those have to be used for idle appropriate expenses. So you can't just use it for anything you want. Debt forgiveness, the PPP, the hope is that the loan will be forgiven. For the idle, the $10,000 is a grant. The only thing is, if you get PPP debt forgiveness or loan forgiveness, that $10,000 is subtracted from your PPP loan forgiveness. So you can't get both the free $10,000 and 100% loan forgiveness. That they thought was double dipping. Deferral of payments, PPP, it's 6 months. Idle, it's 12 months. And for both, interest continues to accrue. And as I mentioned on the payroll tax deferral, 50% gets deferred until December 31, 2021, and 50% until December 31, 2022. And there's no penalties, no interest, no nothing on the payroll tax deferral. I should mention that. And I think that is it. And see if we have pending questions. Edmund, do we have any?
Bridget, thank you both so much. From your friends and colleagues here at the Baton Rouge Area Foundation, we really appreciate the opportunity to, one, have you present, and two, to ask you questions. And some folks have taken advantage of that opportunity. And there's some good questions here. From Ava, if an employer is granted the PPP loan, when will they know that the loan has been forgiven? What about the interest that was charged during the deferral? And will the interest be forgiven also? Can you tell us a little bit about that, what we anticipate that process will look like?
Sure. So the loan forgiveness does cover both principal and interest. You know, in the original statute, it said only principal, but then in guidance, the SBA has said you can get forgiven both principal and interest. The period of it is you have to wait your 8 weeks after you get your loan, and then you apply after that 8 weeks. You have to put together materials, so it might take you a little while to do that. And then the bank is supposed to respond within 60 days to that whether you've gotten your loan deferral or your loan forgiveness or not. So, you know, if you get your loan today, April 15th, June 15th is the end of the 8 weeks. If you filed it right then, it would be, you know, middle of August that you would know that it's been forgiven.
Mm-hmm. And just to add to that, this is Bridget Weiss speaking. To add to that, just like the application process, there are certifications that the borrower needs to make regarding how the funds have been used and their continued eligibility. And just like as part of the original application process, the risk or the liability is really put on the borrower to be making those certifications and as to the accuracy of the information. The bank is not going to be providing guidance, or they may be providing guidance, but you know, essentially the onus is on you for that information to be correct. So there's a very similar process that you're going through now with the application that will then happen at the back end.
Great. Thank you for that.
Keep records of your expenses. That's one, you know.
Yeah, the one thing actually to add to that is that the bank they're supposed to make sure that there's reasonable supporting documentation. They're not going to look behind it and do investigation. So as Jim said, you are going to need to have that information. They're not going to be doing the types of diligence that they would otherwise be doing for a loan. So they'll be taking what you provide at face value, and the risk is on you.
Question from Janet, which is a very, it's a practical application of this. The SBA PPP funds were deposited in our account on Friday, April 10th. Our payroll runs on the 5th and 20th. Payroll on the 5th is for the previous month, and payroll on the 20th is for the current months, 1st through 15th. Should I consider using the payroll beginning April 20th as the first payroll used for the forgivable portion of the loan, or should I use May 5th as the first payroll used?
No, it's done on a cash basis. So I think it would be the April 20th. So it doesn't matter when the services were provided. It's the fact that you're paying people. If you got the loan on the 10th, if you're doing a payroll on April 20th, I think that would be the first one you would include. And then you'd include the May 1, the end of May 1, beginning of June 1.
From DB, for organizations providing 1099 licensed counselors instead of employees, are those 1099 counselors considered employees? I'm assuming that's for purposes of applying.
Yeah, for applying, nope, they're not, because those licensed counselors can apply themselves since they are independent contractors or self-employed individuals, so they can apply. So you can't include 1099. You basically, if you're not paying employment taxes or self-employment taxes on an amount, it can't be included.
Great. We've had one person who's asked us if they can link to this webinar's recording for other nonprofits to use. I'm hoping that's agreeable with our participants. We'll follow up on that.
Sure.
Jim, Bridget, a couple of questions from my gleanings and research, but let's talk about board governance here in this loan application process, and then supervision and how you get to forgiveness. How should our boards be engaged, obviously in the approval level, but going forward through the process?
Yeah, it's interesting. Some people kind of forgot about that or came to realize like, oh, what do we need to do? My view is that even though the PPP may be forgiven, but certainly for the EIDL, which can't be forgiven, the nonprofit is incurring a debt. And so if you would have to go to your board to get approval to purchase, if your loan amount is $50,000, if your check signing authority goes up to $40,000, or you would have to go to your board to get approval to purchase something for $50,000, then, my view is you would go to them to get approval to apply for this loan. And, it's the organization that's going to be held responsible for this stuff. So the board should be making sure that whoever is, putting in the application, whoever is, doing the loan forgiveness, that they are being accurate and presenting information that's accurate. So almost like you might, depending on how hands-on you are or how big your board is, you might want to have some small group of the board review the loan application, review the loan forgiveness application, just to make sure you're comfortable with it.
Mm-hmm. And in the case of a board that I'm on, actually, we have our finance committee working closely with the executive director on the application process, because we have experts in finance, and then the board as a whole has been kept apprised about what's going on. And actually tonight we're having a board meeting where that's not the focus, but is a subject that's on the agenda.
Jim, you and Bridget have a world view and certainly a nationwide view of what's going on. Can you tell us about other sources of assistance that may be available to the organizations, or how they could seek those out? Certainly state, local, and then maybe even national funders.
Right. So there are, different nonprofit groups, different funders are putting together funds to help different types of nonprofit organizations and others. There certainly have been some, most of them are regional. So I have seen and heard of some artist funds or group thing, people who are helping arts organizations in DC, New York, San Francisco. Though not nonprofits, we're seeing these funds to help restaurant owners pop up all over the country as well. And there are other federal government agencies. We got a question the other day from the National Endowment, a question with someone was applying for some emergency grant money from the National Endowment for the Arts. And would that preclude them from applying for a PPP? And, our answer was no, because the PPP doesn't mention anything about that. So, if there are federal agencies that you work with on a regular basis, you might want to see if there are emergency, funding opportunities available. But I would also look at the state, because they might be doing similar mini programs similar to this.
Yeah.
And then certainly in addition, to the extent you receive funding from foundations, some of our foundation clients for their regular grantees are providing additional assistance. And that's coming in a variety of different formats, but certainly being in touch with your regular funders is a good idea, because some of those are providing, I think I've seen some bridge loans in some cases, grants in other cases, particularly to try to keep the programs that they're already funding, to try to keep those operational, or at least to make sure that there's funding or an organization available to run the program once the nonprofit can get up and running again when the restrictions have been lifted.
Yeah, and also another thing on that point is I certainly do a lot of work with scientific research organizations. And so a lot of the grant agreements have funding milestones. When you achieve X, then you get your next round of funding. On both sides, the funder and the recipient should be talking to each other about what they're going to do to change those milestones, because they may be delayed, and does the payment schedule need to be changed to this new reality of the work might not be ongoing, but you still need to pay your staff. And so, what's going to happen? And, if the stock market went way down and now it's coming back a little bit, some funders, the hope is that they will step up and be able to provide some additional assistance to help their favorite charities.
And then outside the medical research space, also thinking about no-cost extensions. If you have a particular grant term, that's another one that more nonprofits may see applicable in their agreements.
Yeah, I would defer to Lori on this, because certainly the Pennington Foundation is one of the major local funders, and I'm sure that Lori has fielded and probably had her board approve extensions or reallocations of previously distributed funding to purposes of, in some cases, survival. But we've certainly seen it at a national level, dealing with the NSF and others on their willingness to easily grant no-cost extensions during this, certainly the shutdown and stay-at-home orders, where people literally cannot work on the purposes of the grant.
And that's, Edmund, I can agree with you on that. That's correct. We've extended that. We've unrestricted grants on many different funders are now unrestricting retroactively grants that they've already given, also unrestricting their current grant cycles. And over 500 different funders have made a pledge to actually give through the National Center of Responsible Philanthropy. They're actually giving, even though the stock market's down, so they're giving emergency grants right now. So if you click on the National Center of Responsible Philanthropy, you can see all the different funders that are participating in that.
Jim and Bridget, I want to be respectful of your time. We have 2 more questions that were submitted. If you'll indulge me, I will ask those. From Melissa, if you've been granted the PPP, can the nonprofit also apply for the EIDL loan? I think we've answered that, but maybe one more time, if you would, for Melissa.
Yes, you can do both, and you don't have to refinance your EIDL loan into your PPP, so you can just keep it outstanding for the 10-year period and pay it back in the normal course.
Great. And from Amy, our organization receives both direct and indirect federal funds, and some of those funds are allocated for payroll. When I applied for the PPP loan, I backed out the amount of payroll covered by federal funds as I didn't want to double dip. Do you think there will be any issues by applying for less than what would appear to be allowed according to our 941 reports?
Right. No, I mean, you didn't have to back out the federally funded compensation, but we do have some who have not applied for the full amount that they're eligible for. Instead, they applied for the full amount that they thought would be forgiven and that they would be able to support on the back end. And the banks aren't, that's not raising red flags for the banks that we've been working with.
Although one caution there is that once you get a PPP loan, you can't get another one. So in many cases, what organizations are doing are applying for the absolute maximum if they think that there's a likelihood that it would be forgiven. Because say, you have this federal funding now, what happens if your other sources of funding dry up, and you won't be able to go back and reapply once you've gotten your first tranche of PPP funding.
Right, and some very conservative, what one person told me they're doing, they're taking the PPP loan, putting it in a separate account. You don't have to have it in a separate account, but they're doing that. They're only paying expenses out of that are forgivable in the right percentages. And then if they don't get the full amount forgiven, they'll just pay back, the rest of the amount right then. There's no penalty for prepayment. And the only cost of that would be the 1% interest during that period.
Yeah, that's great advice. That appears to be all the questions that we've received over the Q&A, and I've asked the major ones that I had. So, Jim, Bridget, I'll say thank you very much for your expertise, for your time this morning, and turn it over to Lori to close it out.
Great. I also just want to echo that. Thank you so much, Bridget and Jim. It's always so helpful, and to Arnold Porter in general for always being there for us and during the toughest of times. This information is invaluable to the listeners. We will definitely send you a link of this presentation as well as the 2020 CARES Act FAQs that just came out that Arnold Porter just put out on Friday. We will send you that. We'll also send you the slides, as well as everything from last week's webinar. You'll get that all in one big package. So thank you very much, and I appreciate everyone for participating. It's been very helpful. Thank you.
Thank you.
Thank you.